Most people think wealth dies when markets fall. That is not how wealth usually dies. Wealth dies the day you learn that what you owned was never really yours without permission. In easy years, a brokerage statement feels like property. In dangerous years, it can turn into a receipt. A bond looks safe until the currency behind it is diluted. A bank balance looks liquid until a government decides stability matters more than your freedom. A stock market looks diversified until the country underneath it becomes the battlefield. That is the mistake most people make. They confuse convenience with control. They confuse a smooth statement with a strong position. They confuse peace, time pricing with war, time survival. I have spent my life thinking about capital allocation, and if you want the blunt version, here it is. When debt gets too large, when governments get cornered, when central banks are asked to do political work, when trade becomes punishment and money becomes a weapon, your portfolio stops being a machine for maximizing return and starts becoming a test of whether you built a fortress or a facade. Most people did not build a fortress. They built a beautiful paper house inside a country they assume will always be trusted. Inside a currency they assume will always be accepted. Inside markets they assume will always remain open. Inside a legal order they assume will always behave the way it behaved yesterday. That is not prudence. That is borrowed confidence. And borrowed confidence is the first wall to collapse. I want you to see the pattern the way I see it. Not as headlines, not as noise, not as one more argument on television. I want you to see it as structure, because once you see the structure, the emotional fog begins to lift. The structure is simple. A government spends more than it can honestly fund. Debt compounds faster than productive output. The gap gets politically unbearable. Taxes cannot close it. Spending cuts cannot close it without pain that elected people do not want to touch. So the burden moves, first into more borrowing, then into more monetary accommodation, then into a slow theft of purchasing power, then into pressure on institutions, then into financial repression, then, if the surrounding geopolitical weather gets ugly enough, into capital war, trade war, sanctions, freezes, restrictions, confiscations, or some softer version of those words with a cleaner legal wrapper. By the time the average person notices, the fortress has already been tested. That is why I do not care whether the danger announces itself with missiles, embargoes, reserve seizures, trade retaliation, banking stress, or a smile from a central banker promising temporary measures. Those are surface forms. The core issue is always the same. Somebody needs resources, somebody controls the rules, and paper claims sit downstream from both. You need to let that sentence sting. Paper claims sit downstream from both. This is why I have never liked the worship of nominal numbers. A person says, my stocks were up, my account was stable, my bonds paid me, my cash was safe. Fine, but in what money, against what benchmark, measured against what loss of purchasing power, measured against which policy regime, measured against what change in the rules? If your statement goes up 18%, while the money unit itself is melting against hard value, you did not get richer the way you think you did. You may have simply lost more slowly than someone standing next to you. That is one of the cruelest illusions in finance. You can feel richer while becoming weaker. The source of that illusion is what I call paper shelter. Paper shelter is the comfort you feel when your assets still have labels, statements, and quoted prices, even though the real protection underneath them has already thinned out. It is the financial equivalent of standing inside a painted set that looks like a brick building from the street, and turns out to be plywood when the wind hits. A fortress is different. A fortress is not built for applause. It is built for siege. That means every layer of it has to answer one brutal question. If trust falls, if liquidity disappears, if currencies are pushed around, if governments become more aggressive, if global capital starts fragmenting, does this layer still hold? Or does it become one more promise waiting for a committee, a counterparty, or a desperate Treasury Department to decide my fate? Once you ask the right question, most modern portfolios start looking flimsy. A lot of people have one home country, one tax system, one banking channel, one stock market, one currency exposure, one legal regime, and one psychological script. They call that diversified, because they own different tickers. That is not diversification. That is decoration inside a single room. If the room catches fire, your labels do not save you. You do not need more labels. You need thicker walls. The first wall of a real fortress is ownership that does not depend on somebody else remaining solvent, cooperative, or politically neutral. That is why gold matters, not because it is fashionable, not because it produces romance, not because it is a prediction market for panic, Gold matters because it does not need anyone's promise to remain gold. It does not ask a central bank for credibility. It does not ask a ministry for permission. It does not require a corporate board to execute. It is not improved by speeches. It is not cheapened by slogans. In periods when paper systems start straining under debt, war finance, and currency distrust, gold stops being jewelry in a vault and becomes monetary spine. Most people hear that and still do not understand the point. They think the argument for gold is return. The real argument is independence. In a fortress, the keep is the last structure standing when the outer walls are hit. Gold is the keep. It is the part of your capital that sits outside the chain of polite promises. That is why physical ownership matters more than clever packaging. A paper claim on gold can behave very differently from gold itself when systems are under pressure. If the point is no counterparty risk, then adding one back in because the wrapper feels convenient means you miss the point entirely. And let me make this uncomfortably plain. If central banks themselves are increasing their gold reserves while the public is still debating whether gold is outdated, you should ask yourself who understands the nature of monetary stress better. The institution that can print money or the saver who still thinks a bigger number in a debasing unit is safety. This is not ancient superstition. It is arithmetic with a memory. History keeps teaching the same lesson. When governments become too indebted and too strategic at the same time, they start leaning on the currency, the bond market, the financial plumbing, and the legal definitions of what counts as orderly. Gold is not magic. It is just one of the few things that does not have to believe them. But a fortress cannot be built out of one stone. This is where people swing from one mistake into another. They hear the case for hard money, then they want a portfolio that is all moat and no interior life. That is not wisdom either. A fortress needs a keep, but it also needs stores, water, supply, discipline, and internal systems that survive inflation without forcing you into reckless decisions. That is why the second wall matters. You need a section of the fortress whose job is not to make you feel brilliant, but to stop inflation from quietly crawling through the cracks and eating your purchasing power while you sleep. That is the role of inflation-indexed sovereign bonds. Most people misunderstand these instruments because they are addicted to nominal thinking. They look at yield, they compare coupons, they chase drama, they miss the central point. In an environment where governments are cornered by debt and tempted by monetary dilution, the saver is not just fighting volatility. The saver is fighting invisible shrinkage. Inflation is a siege conducted without sirens. It does not need to crash your account to damage you. It only needs to make your future claim buy less life. An inflation-linked bond is not exciting, and that is exactly why it belongs in a fortress. It is a ration room, it is stored water, it is the section of your capital designed to preserve real buying power more honestly than conventional fixed income can when the currency is being managed for reasons that have very little to do with your well-being. Do not make the mistake of treating that as a growth engine. It is not a growth engine, it is structural insulation. When the state solves its problems by making the money unit worth less, conventional savings and ordinary bonds can become obedient victims. Inflation-linked sovereign bonds are one of the rare tools that at least try to keep your real footing from sliding out beneath you. They will not make you look like a genius at cocktail parties. They may keep you from becoming a quiet casualty of policy that matters more. Now we move to the third wall, and this is where the home country trap starts exposing itself. If your fortress exists entirely inside one jurisdiction, one currency, one political consensus, one debt path, and one legal mood, you do not own a fortress. You own a domestic story. And domestic stories are exactly what break when reserve systems shift, when alliances fracture, and when major powers begin treating capital flows like military terrain. Most investors do not understand reserve currency transitions because they have lived inside one dominant order for so long that they mistake familiarity for permanence. But no empire gets a lifetime exemption from arithmetic. A reserve currency does not die because people stop reciting its history. It weakens because confidence is stretched by debt, by external rivalry, by overuse, by sanctions, by internal polarization, by policy drift, and by the simple fact that the rest of the world eventually gets tired of financing another nation's strategic excesses. When that process begins, it is rarely announced politely. It shows up in foreign reserve behavior. It shows up in cross-border allocation shifts. It shows up in how hard assets price themselves against the currency. It shows up in what non-domestic investors really keep after translation. It shows up in the difference between your nominal gain and your global purchasing power. It shows up in the way once automatic demand begins to hesitate. You need to understand what that means for your own money. If you are concentrated in dollar-denominated paper because the last era trained you to believe that one country is the entire world, you are not diversified. You are over-identified. You are emotionally national and financially narrow at the same time. That combination can be expensive. Real diversification is not owning 10 versions of the same vulnerability. It is owning meaningful assets across different geographies, currencies, legal regimes, and economic drivers. It is owning businesses and hard assets that do not all depend on the same policy mistake. Not happening. It is stepping outside the one kingdom illusion. This does not mean chasing exotic complexity. It means respecting jurisdiction risk the same way you would respect debt risk. Non-U.S. equities matter in that framework. But not as a slogan. Commodities matter, because the physical world still imposes costs whether central banks like it or not. Industrial metals, energy, agricultural exposure, and other real inputs have a stubborn habit of remaining relevant when paper narratives fail. Select real estate in stable environments can matter. Certain globally recognized tangible assets can matter. The point is not novelty. The point is unshared fragility. I call this the outpost rule. A fortress that keeps all its food, all its fuel, all its messages, and all its people in one courtyard will look organized until the first gate is blocked. Then its efficiency becomes its weakness. Outposts are not clutter. Outposts are survival. They mean a single sanction, a single currency event, a single regulatory surprise, or a single domestic squeeze does not trap all your economic oxygen in one location. This is where a lot of people get lazy. They say, I own international funds. Fine, but are they truly giving you different drivers, different exposures, different legal and currency realities? Or are they just giving you broader participation in the same global momentum trade, dressed in a new label? A fortress does not care about brochure language. It cares whether the wall actually holds under impact. And then we reach the fourth wall, which may be the most important of all. You need uncorrelated return streams. That phrase sounds technical. But the logic is beautifully simple. Most people lose the war before it starts because too many parts of their financial life fail for the same reason at the same time. Their job depends on the same economy as their home price. Their home price depends on the same credit cycle as their bank. Their bank depends on the same policy framework as their bond fund. Their bond fund depends on the same currency assumptions as their cash. Their cash depends on the same political restraint that vanishes the moment the system gets stressed. That is not a portfolio. That is a single failure disguised as variety. A fortress needs multiple supply lines. Not two roads that cross the same bridge. Not three tunnels that all emerge in the same valley. Truly independent lines. Different drivers, different scenarios, different sensitivities, different paths to functioning. When one section is under pressure, another section must still breathe. This is one of the deepest truths in capital allocation. You do not reduce risk merely by buying more things. You reduce risk by buying things that do not all betray you together. A collection of highly correlated assets is like hiring 15 guards from the same village and expecting them to defend you against the village chief. They may wear different uniforms. They still run when the same horn sounds. The mathematics behind true diversification are powerful precisely because they are humble. You do not need to predict the future perfectly if your structure is built so that no single future can ruin you. That is a much saner ambition than trying to be the smartest prophet in the room, and it is far closer to how real wealth survives. I want you to feel the psychological difference between speculation and fortress building. Speculation asks, what if I am right? Fortress building asks, what if the system is wrong, late, compromised, or forced into behavior that polite investors still consider unthinkable? Speculation is ego. Fortress building is respect for reality. That distinction matters because the next phase of this cycle is not likely to reward emotional comfort. It will reward people who understand that stability can vanish much faster than price charts imply. A bank freeze does not consult your spreadsheet. A currency event does not wait for your annual rebalance. A capital control does not care that your retirement assumptions were made in good faith. A sanction does not pause because you preferred broad index exposure. A government under funding pressure does not ask whether its solution is fair to savers. You need to stop outsourcing your safety to normality. Normality is not an asset, it is a mood, and moods change much faster than institutions admit. Look at what debt does to judgment. As obligations rise, policymakers start protecting the system first, the saver second, and the truth last. They talk about resilience while quietly redefining liquidity. They talk about orderly markets while nudging institutions to absorb pain. They talk about confidence while degrading the money unit. They talk about stability while asking you to sit still inside a framework. They are actively altering. Once you see that pattern, you stop evaluating assets by headline yield and start evaluating them by political vulnerability. That is one of the most important system shifts an investor can make. Political vulnerability is now an investment variable. If you ignore it, you are investing with one eye closed. This is where I become very hard on ordinary behavior, because ordinary behavior in extraordinary periods can be ruinous. The average person keeps too much trust in bank deposits, too much concentration in one domestic market, too much faith in long-duration paper, too much obedience to benchmark thinking, too much emotional need for monthly statements that feel calm, and too little interest in whether the calm is real or manufactured. That is not conservatism. That is dependency dressed up as caution. And dependency is expensive when the people running the system are under pressure. Let me give you the sharper version. If your entire financial life requires a central bank to remain disciplined, a treasury to remain credible, a bond market to remain deep, a reserve currency to remain dominant, political factions to remain restrained, and cross-border capital to remain unweaponized, then you do not have safety. You have a chain of assumptions. A fortress is built by shortening those assumptions wherever you can. Gold shortens them. Inflation-linked sovereign bonds shorten them in one specific dimension. Global hard assets shorten them. Uncorrelated return streams shorten them. What you are really doing is taking your life off the honor system. That phrase matters. Most people leave their future on the honor system. They trust their purchasing power to policymakers who benefit from dilution. They trust their liquidity to institutions that can gate them. They trust their retirement to markets that assume open capital flows forever. They trust their currency to a debt trajectory they have never honestly looked at. They trust the legal wrapper more than the economic substance. A fortress investor does the opposite. A fortress investor asks, what part of my wealth is truly mine without explanation? What part keeps up if the money itself is being trimmed? What part sits outside a single national story? What part still works if one line is cut? What part is there before the panic, not after? That last point is crucial. Before, not after. People love the theater of emergency action. They say they will diversify when conditions worsen. They will add gold when fear becomes obvious. They will rebalance internationally when the dollar clearly weakens. They will think about hard assets when inflation returns. They will care about capital controls when rumors spread. They will seek independence when gates start closing. That is fantasy. When systems are truly stressed, freedom shrinks. The menu gets shorter. Liquidity vanishes where you assumed it would wait for you. Prices gap. Restrictions appear. What was easy in peace becomes awkward in tension and impossible in panic. The fortress is not built during the siege. It is built while neighbors are still laughing at the cost of stone. I know that offends the modern appetite for optimization. People want full participation on the way up and instant protection on the way down. They want yield without vulnerability, liquidity without dependence, growth without drawdown, and safety without sacrifice. That is childish thinking. A mature allocator accepts trade-offs. You pay for a stronger fortress with a little less thrill, a little less social validation, a little more patience, and a lot more realism. That is a bargain, because the opposite bargain is far worse. The opposite bargain is to squeeze out a little more nominal performance while silently increasing your exposure to systemic force. That works beautifully until it does not. Then, 1 year of repricing can unwind 20 years of emotional complacency. There is another dimension here that I want you to confront. War changes what counts as prudence. In peaceful decades, prudence is often defined by conventionality, own the standard mix, trust the standard labels, follow the standard glide path, stay within the standard institutions. But in periods of debt stress, monetary stress, and geopolitical stress, conventionality can become the most crowded risk in the entire landscape. If everyone owns the same safe thing for the same reason, And the reason breaks, the safety was theatrical from the beginning. That is why I have no patience for people who measure prudence by popularity. Popularity is not due diligence. In fact, in system terms, popularity is often evidence of laziness. It means the argument has been accepted without enough stress testing. A fortress investor stress tests. He asks what happens under inflation, under deflation, under growth shocks, under recession, under a weaker currency, under tighter capital mobility, under policy confusion, under a credibility break, under an external conflict that moves into trade and finance. He does not need perfect answers. He needs a structure that survives imperfect ones. This is also why I care so much about dignity. A lot of financial advice talks about return as if money were only a scoring system. I think that is a shallow view. The point of money is not to die with the highest spreadsheet. The point is to preserve agency. To keep the right to think clearly when others are forced into bad decisions, to avoid selling at stupid times, because you built no margin, to avoid begging the system for mercy, because you outsourced every layer of protection to preserve the ability to say no. A fortress is agency in architectural form. Gold supports that agency because it does not depend on institutional grace. Inflation-linked sovereign bonds support that agency because they reduce the silent tax. Global hard assets support that agency because they loosen one country dependence. Uncorrelated return streams support that agency because they stop one mistake, one regime change, one frozen market or one monetary event from owning your whole life. Notice what I have not said. I have not said these things guarantee riches. They do not. I have not said they remove pain. They do not. I have not said they turn you into a hero who never. They do not. What they do is much more valuable. They increase the odds that when the world stops behaving the way textbooks promised, you are not standing in the rubble with a perfect theory and a broken balance sheet. That is the real game. Not perfection survival with strength, because once survival is secured, opportunity comes looking for you. Crises do not only destroy, they reprice, they transfer, they expose weak hands, over-leveraged structures, naive assumptions, crowded narratives, and political illusions. The person with a fortress is not forced to run into every opportunity. He has the rarer privilege of choosing. He can buy when others must liquidate. He can wait when others are desperate. He can think when others are begging for the old rules to come back. That advantage is enormous, and it is bought in advance. So let me leave you with the one test that matters. Do not ask whether your portfolio is impressive. Do not ask whether it matched an index last year. Do not ask whether your friends think it is sophisticated. Ask whether it is built to survive a world in which paper promises become political instruments, in which debt eats judgment, in which currencies are managed harder, in which borders matter more, in which access can be restricted, in which nominal gains can hide real impoverishment, and in which the crowd realizes too late. That smoothness was never strength. If the answer is no, then stop pretending you are investing. You are still sightseeing inside the empire. And empire tourists are always the last to understand what the map has become. I would rather you face that now, while there is still time to lay stone, than later, when the first breach has already opened and every smiling expert on television is telling you the walls were never meant to hold anyway. Build the fortress before you need the fortress, because when trust thins, when debt bites, when policy turns tactical, when capital starts moving like an army, and money starts behaving like a weapon, the market will not reward the prettiest story. It will reward the people who own what they could still control. That is the dividing line. Not rich versus poor, not aggressive versus conservative, not optimistic versus fearful, controlled versus dependent, stone versus paper, fortress versus facade. And once you see that clearly, your next decision becomes very simple. You can keep renting safety from the very system that is growing unstable, or you can start buying back your financial sovereignty one wall at a time.